Hello, and welcome to Virtual Investor Conferences. On behalf of OTC Markets, we're very pleased you joined us for our two-day Metals and Mining Conference. Our first presentation of day two is from Heliostar Metals. Please note you may submit questions for the presenter in a box to the left of the slides, and you can view a company's availability for one-on-one meetings by clicking Book a Meeting in the top toolbar. At this point, I'm very pleased to welcome Stephen Sook. He's the Vice President, Investor Relations and Development of Heliostar Metals, which trades on the OTCQX Best Market under the symbol HSTXF and on the TSXV under the symbol HSTR. Welcome, Stephen.
Great. Thanks very much, John. Thanks for having us. So we are Heliostar Metals, and our ambition is to build the next mid-tier gold producer in the Americas. That sounds ambitious. It is, and that's by design. I'm going to spend a few seconds on our title slide here. Our core tenets: speed, grade, and growth. I think these are important. We are very much a growth-oriented company. We have a plan that I'll walk you through to get from 30 to 40,000 ounces of production this year to 300 to 500,000 ounces by the end of the decade. Grade, anyone who's looked at a resource story knows that a little bit of high grade goes a long way, and we certainly have that in our Paula project that I'll go through in spades. And speed. This is something that I think is often forgotten in resource development stories as well, that the time value of money is a real thing. The ability to quickly execute on good opportunities and to move forward apace creates a lot of shareholder value when you're able to do it. We believe strongly, given our pipeline portfolio projects and our operating status in Mexico, that we'll be able to move quickly on our plan. So our forward-looking statements, I'll leave you to read those at your leisure. So why a mid-tier gold producer? This is a portion of the space where you see a lot of value created. It's an interesting snack bracket, let's say, where to get to that 300 to 500,000 ounces per year, you're large enough that you're potentially prey to the senior gold producers, large enough to move the needle on their production profiles and be a potential target. You're also small enough that there's still meaningful acquisitions to be done in the, let's call it 70 to 150,000 ounce per year range. So it's a nice middle ground to be able to continue to grow if you want, or to continue to find a exit for people at that time. And we have a plan, like I said, to get roughly 10 times of production through to the end of the decade. So why Heliostar? Our rapid growth pipeline and near-term cash flow, I think, are really what set us apart here. The fact that we are a gold producer with a cash flow to fund our development project really sets us apart from pure development stories, and also, puts us in a bracket where we have very strong growth compared to steady state gold producers. Our high-grade resource base with upside potential should be eye-catching at very least. Paula is something special, and I'll go through that why in the next little while. And we have many more exploration opportunities beyond what we're currently developing. And then the value proposition is that we re-rate through scale. As you grow as a company, you get an increased multiple, you get increased opportunities, your cost of capital comes down, and that's the trajectory that we're going here rapidly, as I said before. This is a snapshot of our current situation. We're at about 325 million market cap Canadian, at about $1.30 Canadian. Again, we're just around $1 US on the OTCQX. 250 million shares outstanding, 300 fully diluted. Those 29 million warrants are at 40 and 60 cents. So our stock price is well through that. Sorry, 40 and 60 cents Canadian. So our stock price is well through that. It doesn't really provide us any sort of overhang right now. And we expect those to bring in $9 million US over the next 15 months or so. We have some very supportive institutions, Cormark, Hannam & Partners, and Roth in the US, all formally covering us, and a growing number of watchlist coverage, as well as some marquee shareholders. Eric Sprott, Franklin Templeton, and Adrian Day from the institutional side have all been long-term supporters from when we were a much smaller company and have continued to be supportive along the way. So this is our portfolio of assets. A little bit of a brief history lesson here. We, over the last few years, have picked up the assets in Mexico from Argonaut Gold. We were able to buy the Paula flagship asset from them for $10 million in cash, plus $20 million in back-end payments in the end of 2022, early 2023. That really transformed the company into a quality developer. And then as Argonaut Gold continued to unwind, we picked up the rest of the portfolio in Mexico for $5 million US and canceled that $20 million in back-end payments on Ana Paula. So essentially everything you see on this screen, we were able to pick up for $15 million in cash. And speaking round numbers here, we made $15 million from these assets in Q1 alone. So an excellent deal, right time, right place, right situation. Right vision of how to develop in Mexico, and it's certainly paid off so far, and we continue to create value from this portfolio of assets. This is a brief snapshot of what we are working with. Our La Colorada mine and San Agustin are both producing. La Colorada, we're mining from what we call the junkyard stockpile and have been for the last 6 months. It's not junk, don't worry. It was called the junkyard stockpile because it was piled there as waste in the late 1990s in a very different gold price environment. But it's drilled, blasted, and sitting on surface. So this free digging material, we're putting through our crusher and heap leaching and making some very good margin from that 0.2 gram per ton material. At San Agustin mine, we is currently in residual leaching, but a major milestone for the company this week, we announced that we received all of the permits we require to restart primary mining there. We have a plan to put that back into primary production in the second half of this year and be able to generate some very strong cash flows from a tactical opportunity left behind by Argonaut there. And the cash flows from the first two projects to fund our Ana Paula project that really will put us up closer to that mid-tier status that we look to achieve. This is our production pathway. What's in blue and green bars is supported by technical studies. The arrows are what we think we'll be able to produce based on executing some of the other opportunities we see at these mine sites, 30 to 40,000 ounces this year, 50 to 70,000 ounces in 2026 and 2027. And then really the big step change in 2028 when we bring Ana Paula online, adding about 100,000 ounces per year, bringing us up to that 150 to 200,000 ounce per year run rate. And then one of our two development projects to come online beyond that are pipeline projects in 2020-30, adding another 100,000 ounces to bring us up to that 300,000 ounce per year mark. Our 2025 guidance for the year, we issued earlier this year, 30 to 40,000 ounces, which we remain on track to produce at an all-in sustaining cost or AISC of around $2,000 an ounce. Now you'll see on the right-hand side, this is broken down into three different portions. That AISC is somewhat elevated because of the restart costs at San Agustin. There's a bunch of front-end loaded costs that we have to bear in that AISC that brings that up to $3,000 an ounce for the little bit of production we'll have this year from that restart. However, we expect that to normalize to around $1,850 per ounce next year and on a go-forward run rate. These sorts of gold prices, a little bit of production goes a long way. This gives you an indication of the type of margin that we're producing. For year-to-date range, you can see here between $2,300 and close to $3,400 an ounce. Our Q1 came in just above $1,300 an ounce, stronger than we anticipated. Our full-year guidance and each mine site, each producing very strong margin at today's gold prices. And Q1 was our first full quarter of commercial production after acquiring the producing assets in November of last year. Produced about 9,100 gold equivalent ounces or GEOs. Sold a little bit less with a mismatch on the timing of sales, but all that comes out in the wash quarter over quarter. We ended the quarter with $27 million. This is as of March 31st, US $27 million in cash. That's net of paying off $5 million in debt we took on to acquire these assets. Our all-in sustaining cost range is $1,375 to $1,475. That actually came in better than we anticipated. Two factors contributed to that, both the more ounces produced than we'd budgeted for, so we have the denominator factor, as well as our unit cost came in better than we thought. So dollar per ton of rock moved and crushed and stacked, it was lower than we'd anticipated. And that's mostly due to us taking a bit of a conservative view early on with these assets. This is the first quarter we'd really had our hands on them. So great to see that those performing above expectations. In Q1, it was about a 50-50 breakdown between La Colorada and San Agustin. San Augustine will trail off a little bit more in Q2 and Q3 as that residual leaching produces less gold every month as no new ore is stacked, and we really expect that to uptick in Q4 as we get back to that primary mining that I'll go through. La Colorada, we expect that run rate to continue for about the next 2 years and on track to meet our guidance there. So we are a growth-oriented company, so where are the growth opportunities? At La Colorada mine, this is the slide I really like to speak to. This is what really representative of what I like to call our bootstrapping strategy at this asset. As I mentioned, we're mining at the junkyard stockpile for the last 6 months, and for the next 6 months, that gets us about 22,000 ounces of gold through this year, plus the residual leaching from ore already on the leach pad. 2026 production will be likely from this El Dorado stockpile, very similar situation to junkyard. This was stacked in the 90s. We think it's a slightly higher grade based on where it was mined and when it was mined. However, we're just doing the drilling now to confirm the grade of this, but expect that to carry us through 2026 at about 0.2 to 0.3 grams a ton is the range we expect. And then number 3 is our Veta Madre pit. So this is a pushback of an existing pit on site, about 6 months of pre-stripping, 6 months of production, but at a much higher grade. The grade there is 0.76 grams a ton, so we expect very high margin from that short-term opportunity. Number 4 is Creston pit. This is really gives us a 4-year mine life, an additional 4 years beyond 1, 2, and 3 here. It takes about $55 million in stripping to access that 4-year mine life, which would be no problem, except that's going to be at a point where we'd like to be building Ana Paula. So we're looking at a number of ways to tackle this. Do we put a pause on mining Creston, build Ana Paula, and come back to it? Do we look at doing a small project finance facility just to do that stripping? Is gold $4,500 an ounce, and we're able to fund all of this concurrently? Those are all scenarios that we're evaluating right now. At Creston, we see a lot of meat on the bone from what Argonaut left behind. Creston and San Augustine had always been stripped for cash to fund other projects in Argonaut's portfolio. The mantra was, if it cost $1, the answer was no. As soon as the teams on site got a budget and a mandate to go looking for opportunities, they knew exactly where to look. What you see in that top right-hand picture is blast hole data from the Creston pit when it was mined. With no geologic reason why those veins you can see should stop. We're at the pit edges, east and west. So we did more drilling in the first 6 months than have been done in 5 years here, and lo and behold, hit good mineral extensions of those vein structures in areas that had been modeled as waste due to a lack of data points. We also found some very high-grade extensions at depth. So we really see a high-grade underground future here at La Colorada as another future pipeline opportunity. These are obviously highlights, but the grades you'll see there will stack up against any underground mine in Mexico. I think there's a very attractive economic opportunity there in the future at this asset. Overall, with the drilling we've done, we'll be incorporated in a new feasibility study that's due to come out in the next several weeks, so stay tuned for that. That'll show the impact of remodeling, our better understanding, the additional data points, and reshuffling, some of the things that were shown in the previous tech report in line with what I just outlined in our growth strategy on the previous slide. At San Augustine mine, this is a very exciting time for us at San Augustine. We just received the permits to be able to mine what we call the corner area. That's this green corner that you can see beside the pit. This is a great tactical opportunity for us and shows that Mexico is permitting mines and is a great place to operate long term if you're able to have the right relationships. For a $4.2 million initial capex bill plus a little bit of working capital, we'll be able to generate $40 million in free cash flow from mining this area over the next 14 months once it comes into production in Q4 this year. That's at a $3,000 gold price. So with a little bit of exploration success, and there's some very good oxide gold targets right around this area, and at a slightly higher gold price, I don't think it's a stretch to think we could be looking at 50 to 60 million generated for the company over the life of the oxides at this asset. Below that as well, there's a very large sulfide deposit. This is something we're investigating. It's polymetallic, porphyry-driven deposit that has similar signatures to that of Penasquito and the Camino Rojo deposits in Zacatecas. This is something we're investigating that, again, is another pipeline opportunity that was never fully run to ground by Argonaut, and is something that could be a game changer if it shakes out the way we think it could. So the idea is that from San Augustine and La Colorada over the next 2 years, we'll be able to generate 120 million in asset level free cash flow. That will fund the equity portion of the build for the Ana Paula project, which remains our core flagship project and key development asset. We purchased this in 2023 for 10 million, as I mentioned, but it had over $100 million invested into it previously with some good infrastructure, open pit mine permits, a camp. There's a portal and, an underground, and a bunch of drilling that really de-risks what this asset looks like. So this was presented to the market by Argonaut as a large refractory open pit, low-grade open pit with a complicated flow sheet, marginal economics. Credit to our technical team that saw the opportunity that it wasn't that. Actually, 80% of the economics are contained in this 1.15 million ounce high-grade core of the deposit. So Ana Paula is something special in that it's a bulk tonnage, high-grade deposit. It's very rare in the industry that you can say those two words together. And when you can, the margin implications are astounding. So there's a few things I'll draw to your attention on this slide. The first one is this, the dimensions, 280 meters long, 100 meters tall, and 60 meters wide. So this is a true bulk tonnage deposit, and it comes with the economies of scale to go with that in terms of the mining economics. Right now, if you combine both measured and indicated and inferred, we've got about 1.15 million ounces at just shy of 6 grams a ton. And we are in the middle, I've just started a 15,000 meter drill program that's looking to convert that inferred material into M&I, as well as look at some extensions, trying to get that up to about 1.5 million ounces at similar grade once we're through that drill program. So what's our pathway to turn this great opportunity into cash flow for investors? So the first one is design. We're moving quickly here. Again, speed is a core tenet. We're moving directly to a feasibility level study that we expect to have out in about 12 months' time. That will show a 6 to 7 year mine life based on only the measured and indicated resources, but with good visibility from our ongoing drill program to get to those inferred resources into a mine plan in the next iteration and show a 10 to 12 year mine life. We're doing the technical work now to be able to finalize the flow sheet and submit this. The flow sheet, when we looked at just this high-grade core, is mostly not refractory with very conventional technology. We can get up to 90% recovery. I actually get 20 to 30% gravity recoverable gold that drops right out. And then a flotation to a carbon in leach or CIL circuit that'll get us up to 80%. And then in today's gold prices, we're looking at adding a small bio-oxidation circuit on the back end to be able to recover some of that refractory material around the edges that'll allow us to drop the cutoff grade, expand the margins of the deposit, and be able to make some good money doing that. All that work will go into a permit submission in Q3. This is actually fully permitted for that open pit mine. We could start building that tomorrow if we wanted to. We don't want to because we like the economics of our project a lot better. But all that to say that we'll benefit from this permitted status in submitting those permit modifications in Mexico. We're going to have a smaller footprint. We won't have a big open pit. Most of the tailings will go back underground as backfill. We'll have a 1,500 ton per day plant as opposed to the 6,000 ton per day plant that's permitted. So again, smaller footprint, less water use, and everything that will make the government look good approving this smaller project with better economics. We've been told that permit will take about 9 months to turn around, and that's what we're expecting. Alongside that, we'll start to look at project financing. I mentioned we're looking at having about $120 million in free cash flow to fund the equity portion. So we will be looking at some debt financing here, looking to bring those groups inside the tent in early January, so they can work alongside that feasibility study and get comfortable with the way the project's progressing. The idea here is that in 12 months, we will have a feasibility study, a permit, and a financing package all ready to announce in about 12 months' time, all at the same time, move quickly into a construction decision, 18-month construction, and in full commercial production in the early part of 2028. We think we'll be able to mine, mill, and support this operation's G&A expenses at about $115 a ton. And with the extremely high grade sub panel here, 200,000 ounces at greater than 10 grams a ton, that's $1,000 per ton rock in that highest grade portion. So we see very attractive economics. We think will be a very competitive process for the project financing, given that we'll be able to show a 12 to 14 month payback period. Then we have two pipeline projects that will be at that 100,000 ounces, either San Antonio in the Baja, which is, we're working on a permitting pathway there, or the Cerro de Gallo project in the prolific Guanajuato district of Mexico. Either of these could add about 100,000 ounces a year. We're currently working on a pre-feasibility level study for Cerro de Gallo. That'll let us bring about 2.3 million ounces in resources that we have to treat as historic right now onto our books, and then give us an indication of what we think the economics will be there. We see this as a very attractive project in today's gold price environment, but stay tuned for the results to come out there. We'll also, over the next little while, have drill results from Ana Paula, which we expect to be very high grade, given that they'll be focused on infill and high probability step out drilling, and then our Q2 results to come out shortly as well. This is our peer comps and valuation. Really, like I said, we're looking to grow through scale. If we can be a 300 to 500,000 ounce producer by the end of the decade, we should be a $2 billion market cap company. This is not cherry picked. These are kind of all the companies in that range in the gold space that produce around that level. That arrow on the right hand side points to the average. So if we're able to execute on this plan, you could easily see a 3 to 6x re-rating on our market cap. In terms of peer valuation, we have sector leading exposure to gold price through our gold inventory in the ground, and with a very clear pathway to turn that into monetize it for shareholders. Our management team is very technically oriented and top notch. Our CEO, Charles Funk, is an exploration geologist was an exploration geologist with Newcrest in Australia. Also had commercial success with the Panuco discovery with Vizsla Silver, and then has been focusing on Heliostar for the last several years. Greg Bush, our COO, came out of retirement to help build Ana Paula because he thought it looked like fun, and I'd have to agree. He was the CEO of Capstone Mining for 9 years and SVP of Technical Services for Equinox Gold Corp, working at the Los Filos project, which is in our same neighborhood. So, he's the one. His expertise really allowed us to purchase those operating mines and be able to look at running a gold mining business. And the rest of the team is equally as well qualified. I'll let you peruse their bios at your leisure. These are upcoming milestones that I've gone through. This slide doesn't change, is one of our core tenets, except for the number of check marks and color of the text. This is our plan, our path forward, and we intend to stick to it. So that shows our ability to generate near-term cash flow to support our business plan, insulating us from the whims of the markets to a degree. Our high-grade resource base and what we think will be the margin implications once we're able to get Ana Paula online in 2028, and then our value proposition to be able to create value through investors, re-rating through scale, and executing our business opportunities as we continue to go down the de-risking pathway. Thank you very much for listening to our story. I see there are a number of questions in the chat here, so I'm going to go through and address some of those. The first question here is about Torex Gold, which is in the same neighborhood as our Ana Paula project. Actually, I'll push this slide in our appendix. So we are in what's called the Guerrero Gold Belt. The Morelos complex is mined and on the books 15 million ounces. Los Filos is 30 kilometers away, but still in that same belt. That's 12 million ounces mined and in resources. So this is elephant hunting country. Torex recently invested $800 million to develop their underground mine there. So a very good place, precedent to set in terms of investment, and something that we're happy to be in the same neighborhood as. They're focused on their project, and we're focused on ours. So don't see that as a sort of competition, but it certainly shows that you can create a lot of value in the Guerrero Gold Belt. Another question here about how does our all-in sustaining cost compare to our neighbors? Our all-in sustaining cost is, I'd say, average across our current producing portfolio. When Ana Paula comes online, we expect that to be life of mine under $1,000 per ounce all-in sustaining cost, which would be, I think, first decile, top 10% globally, based on just that rare combination of high grade and bulk tonnage. I off the top of my head don't know what Torex and the ASIC at Los Filos is. But I know that it's certainly north of $1,000 an ounce. Another question here on La Colorada. Is La Colorada fully permitted for your growth projects at that site, such as your plans with El Creston? That's a great question, because permitting in Mexico is certainly something that we are focused on and have had success in. We have been granted a number of permits that we need, like I said, at San Agustin. At La Creston is the same idea. We've been granted permits to drill that El Dorado stockpile. We've been granted permit modifications to expand our leach pad. We have been granted the right permits to be able to monetize and move that El Dorado stockpile. We do need a permit to be able to mine the Veta Madre pushback. So that's one permit we need, and another slight variation to get the full 4 years at El Creston. But again, when it's an operating mine site, your ability to get permits is increased, I would say. Nothing's for sure, but certainly easier when you're able to show to the government that we'd like to continue operating, to continue to support the local community, provide jobs, pay taxes, support our community and water programs that we're very proud of. And be able to extend the life of these assets that are already in place. So there are a few small permits along the way to execute our full plan there, but we're seeing more and more confidence that we'll be able to get those. So there's another question on the greatest remaining risk for San Agustin coming online in Q4. I think right now it's really just about our timeline to execution. We're looking at selecting contractors, doing a confirmation and step out drill program. Like I said, it's on us now. I don't think there's much that's outside of our control that could make things go sideways there. We've been waiting for this for a while, so the team is ready to go. We've actually kept on a larger workforce than we should have for residual leaching, anticipating that we'd be able to progress towards this restart. So we have a bunch of staff on site who are already familiar with the asset, trained operators who know this ore body and know how the operation runs, that are able to get up and running quickly now that we've got that positive decision on the permit. So I think it's really just down to us to execute there. When was the last time a permit like this was issued? I assume a permit like this, it refers to the San Agustin permit. It's been a while, honestly. There under the previous administration in Mexico, their open pit permits were not forthcoming. So there have been a number. It's not to say they weren't issued. Again, you saw Orla's Camino Rojo get permitted through the AMLO administration. But then about halfway through his administration, no more open pit permits were issued. When the Sheinbaum administration came in November, there were a slew of underground permits that they issued very quickly, as a positive signal to the industry that responsible development would be supported. But certainly this is a major milestone, I'd say, in the future of open pit mines in Mexico, that we were able to get this permit, and we intend to continue on that momentum. Question here on our cash flow, and be able to support that. We have sufficient cash flow. Yes, with the 30 million in the bank we have right now, give or take, and our cash coming in the door from our operations, we're very well funded to continue. We believe that we have a pathway here to be able to get to 300,000 ounces a year without issuing another share. That's not a promise that we will never issue another share. There's always opportunities that come up in the market in terms of the right valuation, the right M&A opportunity, the right way to accelerate our business plan to create value. But we have no plans in the near future to issue any more equity. Also a question almost on the flip side here, any plans to pay dividends? Frankly, no, not in the immediate future. We see enough growth and value opportunities in front of us from reinvesting in the business that we would like to. So, no dividends yet, but maybe when we're at 500,000 ounces a year. With that, that's all the time. I'd like to thank everybody for attending today and have a great day.